we are diving into this ICAN Communique
Yeah.
from March 2025. It's pretty packed with info. So we're going to try to, cut through the noise and give you guys the key insights without, making you feel like you are drowning in data.
Yeah, exactly. We are looking at, well, everything from inflation, the rate at which prices are rising, and the central bank's moves on interest rates. But we are also looking at significant regulatory updates. And then even, we're taking a peek at the financial well-being of women. But yeah, I think the goal here is to kind of connect these dots
Yeah.
and to really, figure out what it all means.
Great, great. So I guess the place to start is inflation. The communique does mention a welcome drop in India's CPI inflation to a 5-month low of 4.31% in January.
Right.
Now, CPI, or the Consumer Price Index, it basically tracks, the average change in prices for things that we buy and use every day. So, I mean, that's good news, right?
Yeah, definitely. And a big part of that was that food prices eased. They kind of cooled down to 6.02% from, a rather high 8.39% in December.
Yeah.
So that's a big change.
So why is food inflation cooling down?
So there's an interesting story there. Both Rajani Sian from Care Ratings and RBI Governor Sanjay Malhotra, they point to really strong agricultural production, right? A good monsoon season meant a good harvest, and water reservoir levels, they're quite healthy as well, and that's good because that could provide a cushion. If future monsoon seasons aren't so great, it's a good buffer to have.
Yeah, no, that's great. I mean, nature's kind of helping out here, right?
Yeah.
But core inflation, which basically strips out food and fuel prices to give us a better sense of those like underlying price pressures, it stayed pretty much the same, right? It was at 3.7%. So I guess that means it's not all like cooling down across the whole economy.
Right. And that's important because it suggests that while, some of that immediate pressure from food prices, it has eased, the kind of more deeper inflationary forces in the economy. They haven't really changed that much.
Okay.
And we should also note that the RBI governor, he did sound a bit of a note of caution about risks. He thinks there are some upside risks to inflation.
Yeah.
And he specifically mentioned uncertainty in global financial markets and also the ever-present volatility in energy prices. And of course, you can never predict the weather, right? So those are things that could, kind of push inflation back up again.
Okay. So some good news, but I guess we got to stay aware of those potential risks.
Yeah.
So let's look at wholesale prices now. India's WPI inflation also went down in January. It hit 2.31%. Now, WPI, or the wholesale price index, it tracks the changes in prices of goods at the wholesale level. And again, we're seeing this trend of lower food prices and stable fuel rates. That seems to be driving the decline. And Rajani Sina, she reiterated that she expects food prices to continue to ease in the coming months because of these kind of seasonal effects.
Right.
So if we put it all together, we see both consumer and wholesale prices easing up, right? So I guess the big question now is, what will the Reserve Bank of India, or RBI, our central bank, what will they do next? I mean, how will they react to this easing in inflation?
Yeah, I mean, it naturally leads you to think, what will the RBI do? And Aditi Nair from ICRA Ratings and Ragani Singha, they both think that we could see another cut of 25 basis points in the repo rate. Now, a basis point is 1/100th of a percentage point.
Okay.
So 25 basis points would be 1/4 of a percentage point. They're looking at April or June. Those are the meetings where they think this could happen.
Okay. And speaking of the repo rate, the Monetary Policy Committee, or MPC, the body within the RBI that sets interest rates, they did just make a move. They cut the repo rate by 25 basis points. So that brought it down to 6.25%. And this was actually the first such cut in 2 years.
Wow.
And the communique says it was a unanimous decision. It was driven by that easing retail inflation we just talked about. And also, there are signs that economic growth is slowing down a bit. So I guess the RBI is trying to, balance controlling inflation with making sure growth doesn't completely stall, right?
Yeah. I mean, it's really interesting to note the timing here. This was the last MPC meeting for FY25.
Okay.
And it was also the first meeting with the new RBI governor, Sanjay Malhotra. So this is a pretty big decision to make right at the start of his tenure. It could be a sign of things to come, how he approaches policy.
Definitely something to watch. And despite, the ongoing global trade tensions, which, can definitely put a strain on currencies, the MPC, they decided to keep a neutral stance.
Okay.
So I guess that means, they're not leaning towards, tightening things up to combat inflation or aggressively easing, to try and really boost growth. I guess they're kind of, keeping their options open.
Yeah, I mean, it really highlights that, central banks have to, they have to walk a tightrope. They have to consider what's happening in their own country, but also all those global factors that can have a huge impact.
Right, right. Makes sense. So let's move on to the services sector now. The PMI data shows the growth in India's services sector. Well, it slowed down in January. In fact, it slowed to a more than 2-year low. So the HSBC final India services PMI index, it fell to 56.5. In December, it was at 59.3. Now, I mean, anything above 50 does indicate growth, but this is a definite slowdown.
Yeah. Yeah, it is. But it is worth noting that the data actually shows that that demand is still strong. It hasn't really weakened. And because of that, we saw a pretty decent rate of hiring in the sector. Actually, it was one of the fastest rates of job creation since they started collecting data on this index, which was back in December 2005. And we're seeing, both full-time and part-time positions being filled. So I think that shows that there is still a degree of optimism among service providers.
So even though growth is slowing, they're still hiring. I guess they expect that demand will pick up again at some point.
Yeah. Yeah, exactly. And the report does also mention that that new business, it continued to increase, although the rate of expansion was the weakest in 14 months. And they think that's partly due to strong demand, but also competition.
Yeah.
The market's getting more competitive, so businesses are still finding new clients. It's just not happening as quickly as it was before.
Makes sense. Okay, so let's move on to SEBI. The communique highlights that there's a new SEBI chairperson. Now, for those who might not know, SEBI is the Securities and Exchange Board of India. They're the regulator for the stock market, so it's a pretty important role. So Tuhinkanta Pandey, who was the finance secretary, he's been appointed as the new chairperson, and he'll be in that position for 3 years. He's taking over from Motabi Puribuch.
Okay, yeah, and Tuhinkanta Pandey, he brings a lot of experience to the table. The communique mentions that he held some key roles before this. He was head of the Department of Public Enterprises and the Department of Investment and Public Asset Management, and notably he was also involved in some big government initiatives like the sale of Air India and the IPO of LIC. That's the Life Insurance Corporation of India. So yeah, I mean he's got a pretty solid background.
Yeah, that's a lot of experience, and that extensive background, I guess, will probably come in handy as he guides SEBI through a pretty dynamic financial landscape. And SEBI, they make decisions that affect all kinds of investors. So it's definitely an appointment that people are going to watch closely.
Yeah, for sure. Speaking of things that people are watching closely, there's this kind of sell India, buy China narrative that's been gaining some traction.
Okay.
The MSCI China Index, which is basically a benchmark for Chinese stocks, it has been outperforming the MSCI India Index, its Indian equivalent, recently. So that's kind of fueling this idea that maybe it's time to sell Indian stocks and buy Chinese stocks.
Right. So what do the experts think about this? Is it really time to jump ship?
So Nomura, which is an investment firm, they don't think this outperformance by Chinese equities is going to last. They see it as a short-term thing.
Right.
But they do say that, it could continue for a bit longer. In the near term, we might still see Chinese stocks doing better.
Okay.
But interestingly, despite this short-term view, they still have an overweight stance on India in their Asia ex-Japan portfolio. So they're actually recommending holding a higher proportion of Indian stocks compared to, the benchmark. And they have a neutral rating on China.
Interesting. So they're still bullish on India for the long term.
Yeah, their long-term view on India is still positive, but they do see some risk, in the short to medium term. They think that Indian stock valuations, they could decline, and they call this multiple compression. So basically, the ratios that people use to value stocks, they could go down, and that could lead to lower returns. And they think this risk is partly due to this, the sell India buy China narrative, but they also point to some domestic factors within India. They also mention that if the U.S. dollar weakens,
Okay.
and the dollar has been strong, recently. So if it weakens, they think that could actually renew interest in the Asian foreign markets. Now that's the Association of Southeast Asian Nations, and it's their 4 largest economies, excluding Singapore.
Okay.
So Indonesia, Thailand, the Philippines, and Malaysia.
Got it. Okay. So what are the specific things that Nomura sees as risks or challenges for India, going forward?
Well, they mention, first of all, a slowing economy. They also talk about, potential earnings downgrades. So companies might not, meet their earnings expectations. They also mention tight liquidity in the banking sector. So basically, less money available to lend. And they also talk about potential risks of higher tariffs from the United States, which is interesting because, some people think that India might actually benefit from the, the global trade tensions, but Nomura sees that as a potential risk. And they also mention a weakening of the Indian rupee.
Right. So a mix of both domestic and global pressures. But their view is that the slowdown in India it's more of a blip, right?
Yeah.
It's cyclical. It's not like a structural long-term problem.
Yeah, that's right. And they point out that, there are some policy responses already in place that are aimed at supporting growth. So the RBI, they've injected some liquidity into the financial system. We've seen the recent cut in the repo rate. And the government, they've also taken some modest measures in the recent budget to try and boost consumption. And there's also been some easing of what they call macroprudential measures. So these are basically, regulatory tools that are used to try and keep the financial system stable. But they do say, that it's going to take some time for all of these measures to really have an impact on the economy.
Cool.
It's not an overnight fix.
Right. But their long-term confidence in India is still there.
Yeah.
Because of some fundamental strengths.
Yeah. Yeah, exactly. They emphasize, some of the things that make India attractive to investors. First of all, it's a huge market. It's very large and very liquid. And that means it's easy to buy and sell investments without really affecting the price. And they also say that, there are lots of high quality companies in India. And they also believe that India could actually benefit from some global trends, like companies diversifying their supply chains.
Okay.
And changes in international trade patterns. And they also think that, India has the potential for strong earnings growth and strong GDP growth, in the future.
Okay. And they mentioned one other thing, which kind of seems like a silver lining. They said something about current investor positioning.
Yeah. So they looked at some large emerging market investment funds, and they found that these investors are already underweight on India. So that means that they're holding a lower proportion of Indian equities in their portfolios compared to the benchmark.
Okay.
So basically, they've already reduced their exposure to India. And Nomura's thinking is that, well, this underweight positioning could actually, limit further declines in Indian stock valuations because, there aren't a lot of investors out there who still need to sell.
Okay. That makes sense. So let's, shift gears a bit and talk about some of the key reforms that the Communique talks about. The first one is the Income Tax Bill 2025. It's been introduced in the Lok Sabha, which is the lower house of India's parliament, and the finance minister, she's asked a select committee to examine it.
Okay.
So what's the big deal with this bill?
So the main thing is that it's all about simplification. And the Central Board of Direct Taxes, they've put out some initial clarifications, indicating that once this bill becomes law, we're going to see some new rules, some new forms, and some new software, to make things easier. And one of the big aims is to consolidate all the different provisions related to salaries and all the different kinds of deductions and put them all in one place. So it'll be much easier for people to figure out what they need to do when they're filing their taxes. They won't have to wade through all these different sections of the law.
Right. That sounds like a good thing. And there's also a change in the terminology used for tax years.
Yeah.
Moving away from previous year and assessment year to just tax year.
Yeah. They're saying that, this would bring India more in line with international norms.
Okay.
A lot of other countries already use, one term for the accounting period for taxation. So I guess it makes things a little bit more consistent and maybe a little less confusing.
Right. Makes sense. Another reform that's worth mentioning is the change in timeline for AIS to hold their investments in DMAT form. Now DMAT or dematerialization.
Yeah.
That's basically converting physical share certificates into electronic form.
Right.
And SEBI they've extended some of the deadlines for this. So what's the key takeaway here?
So the main thing is that any new investments that are made by AIFs on or after July 1, 2025, they have to be held in DMAT form. But investments that were made before that date, they're generally exempt from this requirement.
Okay.
There are a couple of exceptions, but generally, if you invested before July 1st, you're okay.
So what are those exceptions? Like when would older investments need to be dematerialized?
So there are two main situations. First of all, if the company that the AIF has invested in, if that company is required to dematerialize its securities, then the AIF would also have to hold its investment in DMAT form.
Okay.
And the second situation is if the AIF, along with some other SEBI-registered entities that also have to hold their investments in DMAT form, if they collectively control the company that they've invested in, then even their pre-July 1st investments in that company, they would have to be dematerialized.
Got it. Okay. So what about the deadline for converting those pre-July 1st investments to DMAT form? I mean, if those exceptions apply, when do they have to do it?
So the new deadline is October 31st, but again, there are some more exemptions, for schemes that are ending on or before that date, or schemes that had already been, given an extension as of February 14th. But yeah, I mean, ultimately, it's the AIF's trustee or sponsor who's responsible for making sure they comply with all these rules.
Okay. So another thing that SEBI has been working on is setting some new rules for algo trading. And that's often called algo trading. So this includes, a requirement for algo trading providers to be impaneled with stock exchanges, and there are also new guidelines for the use of application programming interfaces or APIs in trading. So this seems like a pretty big step towards trying to close some of the gaps in the regulations and to protect investors.
Yeah, exactly. And it's important to understand that, SEBI isn't directly regulating the algo providers themselves,
Yes.
But these new rules will be implemented and enforced through the stock exchanges.
Okay. So how is all this going to work in practice? Like how will the empanelment process work and how will the API rules work?
Okay, so the Brokers Industry Standards Forum, they're going to be responsible for coming up with the detailed implementation standards. And they've got until April 1st to do that. And then these new rules will come into effect on August 1st.
Okay.
And the stock exchanges, they'll be the ones supervising, all the algo trading activities. They're going to define the criteria for empaneling algo providers. And this is important. Brokers will only be allowed to onboard algo providers who've gone through that empanelment process and who've been approved by the exchange.
Okay.
The exchanges will also handle any complaints from investors about algo trading, and they'll be monitoring things to try and detect any prohibited practices.
Right. Okay, so what about the APIs? How are those rules going to change?
So basically, open APIs, they won't be allowed anymore. For algo trading. So access will only be granted through unique vendor clients. So this is all about identification and traceability.
Okay.
So they want to be able to to identify every algo-driven trade, and to be able to track it back to the source, and that's all about accountability.
Okay. So what about individual investors,
Mm.
who develop their own trading algorithms? Are there any new rules for them?
Yeah, so if you develop your own algorithms and they're executing orders at a certain rate, like a certain number of orders per second, you're going to have to register those algorithms with the exchange, and you'll do that through your broker. But there is a provision that says that your immediate family members, they can also use the algorithms that you've developed. And then there are also some specific rules for what they call black box algos. Now those are algos where the underlying logic is proprietary. It's not disclosed. So providers of those black box algos are going to have to register themselves with SEBI as research analysts.
Okay.
And if they make any changes to the logic of their algos, then they'll have to re-register. And they also have to maintain detailed research reports, to kind of justify their trading strategies.
Okay.
And then to make things even more transparent, all the orders that come from algos, they're going to be tagged with a unique identifier. So that creates an audit trail.
Okay.
And brokers, they also have to get approval from the exchanges, if they want to make any changes to algorithms that have already been approved.
Got it.
And the exchanges, they're going to be issuing, standard operating procedures for testing algos and for monitoring them.
Okay. And one last thing on algo trading. The Communique mentions something about the sharing of fees. What's that all about?
So basically, SEBI's saying that the algo providers and the brokers, they can share the subscription charges and the brokerage fees that they collect from clients who use their algo trading services.
Mm-hmm.
But they have to make sure that all the charges are clearly disclosed to the client.
Okay.
And they have to make sure that there's no conflict of interest.
Right. Okay. Makes sense. So moving on to another area where there have been some regulatory updates. SEBI has revised the timelines for issuing consolidated account statements, or CAS.
Yeah.
And these statements basically, give investors a consolidated view of all their holdings, all the securities that they hold in DAMAT form.
Right.
And the goal here is to make things a little bit easier for the intermediaries, the folks who are involved in the process. So what are the changes?
Okay, so basically, they've extended the deadline for AMCs. Now, those are asset management companies. They manage mutual funds,
Okay.
and also for mutual fund transfer agents, or MFRTAs. They've extended the deadline for them to provide the common PAN data, to the depository. So instead of having 3 working days, they now have 5 working days after the end of each month.
Okay.
And then the depositories, they'll send out the ECAS, the electronic version of the CAS, by the 12th of the following month, and the physical version, they'll send that out by the 15th. And the deadline for AMCs and MFRTAs to submit the half-yearly CAS data, that's also been revised. So they have to do that on or before the 8th of April and October each.
Okay. So the process is the same. It's just that the timelines are a little bit different.
Yeah, exactly. It's important to note that the monthly issuance of the CAS via email, that won't change. So if there's been any activity in your DAMAT account or your mutual fund folios during the month, you'll still get your CAS by email. And these new timelines, they'll come into effect on May 14th.
Okay. And then one final thing on the regulatory front. SEBI has also proposed some changes to the norms for related party transactions, or RPTs. So these are basically transactions between a company and its related parties, like its promoters or directors or subsidiaries.
Right.
And the idea here is to try and reduce some of the ambiguity in the existing rules, and to increase transparency. Particularly in the secretarial audit reports, the reports that review these transactions. And it also addresses some concerns that have been raised about some auditors maybe not having enough experience, to be involved in these reports.
Right. So there's a specific recommendation to add a monetary threshold in addition to the existing threshold, which is based on 10% of the subsidiary's standalone turnover.
All right.
So the idea is that if a subsidiary of a listed company wants to do an RPT,
Yeah.
then they would need to get approval from the list company's audit committee if the transaction is above a certain amount, and the proposed limits are around 1,000 crore rupees for mainboard listed companies, and around 50 crore rupees for companies that are listed on the SME platforms. So those are the small and medium enterprises platforms.
Okay, so it's basically trying to make the criteria for needing approval a little bit more concrete.
Yeah, exactly.
Okay, so let's switch gears again and talk about something that's really important and timely, especially since it's International Women's Day. The Communique has a whole section on how to ensure the financial well-being of women. So I think this is really great. So what are some of the key steps that they recommend?
So they lay out 9 key steps that women can take to build a secure financial future. And the first one, it's pretty basic, but it's really important. And that's to earn your own income.
Right.
To be financially independent, to use your skills and your talents to create your own income. And then the second step, it builds on that. It's about being ambitious.
Okay.
About having a vision for your career or your business, thinking about, how you can grow and achieve your goals.
Right. And then the third point, it's about knowing your worth.
Right.
Making sure you're being paid fairly.
Yeah, exactly. That, it talks about the importance of negotiating, for fair compensation and understanding, what you're worth and what the industry standards are. And then the fourth step, it's a cornerstone of financial security. I mean, this is true for everyone, not just women.
Yeah.
And that's to have an emergency.